Welcome, everybody. This is Sheila Vertino, and I'm pleased to be your host today for the NAIOP Solution Series. If you're returning, you know already that the Solution Series programs are a free member benefit, and what we're trying to do here is kind of give you a mini webinar that takes place in 30 minutes or less, and you'll come away from them with some quick tips and insights. We want to keep the emphasis on positive strategies and tactics to help you succeed in today's rather tough business environment. As always, we ask you to help us to drive the content. We're very eager to hear what topics you would like to have programs presented on, and if you know of anybody who could be a good speaker, just go ahead and email us that information at any time. There'll be some contact information at the end of the program. You'll get a survey, and you can just add your thoughts to it. And we would definitely appreciate that. And we also appreciate our sponsor for today's program, and that's Northmark. Northmark provides commercial real estate services for investors, developers, corporations, and tenants. They offer mortgage banking and commercial loan servicing in 32 offices and property management of commercial space in 22 markets, along with corporate services, brokerage, and investment sales. You can visit their website at www.northmark.com. We mentioned that the Solution Series is kind of a quick bite of educational information, but some topics require a more in-depth discussion. And as you can see on your screen, we think distressed debt and receiverships and management opportunities, that's one of those much larger topics that requires a 90-minute webinar. Now these webinars, as opposed to the Solution Series, the webinars are fully interactive. They let you submit your questions to the presenters during the program and you know, have a dialogue going. The next full webinar will take place on November 18th, which is a Thursday. During this webinar, we'll explore opportunities to assist with troubled assets, determine strategies to get in front of the lenders, discuss the skill sets required, and then we'll conclude by delving into several case studies. The cost of the full webinar is $65 for NAIOP members and $95 for non-members. If you'd like to register, you just go to naiop.org/webinars. Now let's get on with our Solution Series program for today. With us is George Livingston, and George is the founder of and a principal in NAI Realvest, a major commercial brokerage firm in Central Florida. He has over 25 years experience in site selection and land development in Florida, with a long and extensive history of successful development in the Florida industrial warehouse market. George is also a very active NAIOP member. He currently serves as governor of the NAIOP Research Foundation, and he's a past president of the Central Florida chapter. He's a member and past chairman of the Industrial Development Forum and Trends Committee. And George, welcome today. And I'm sure everybody's curious to hear more about how you can attract foreign capital and create jobs through the government's EB-5 program. So go ahead and tell us everything about it.
Okay. Thanks, everybody, tuning in. In addition to the brokerage company, we also have a development company, and we run 2 funds. Everyone always asks what EB stands for on the EB-5 program, and it stands for employee-based. And there is EB-1, 2, 3, and 4, some other way of doing employee-based investing. And anytime you see EB-5, in the back of your mind, thank you for every investor, it had 10 jobs associated with it. Historically, it has had a mixed success, but it's designed to provide a conduit to raise foreign capital in America. And in fact, it's raised about $2 billion so far. And it's to create jobs, and so far it's created something more than 44,000 jobs. And it has historically targeted rural and high unemployment areas, and that can be a problem as you look for your projects. However, right now, almost all of America has high unemployment, so the issue in the short run has gone away. For the overseas version, for the investor, it's really designed to provide them a predictable route to U.S. visa for those who are qualified. And each year, there are 10,000 visas allocated for this program, and the regional center has to compete with the EB-1, 2, 3, and 4, but more than half of the visas are set aside for the regional centers. And in fact, only about 30% are ever used or less, 10 to 30. So going over the quota is not likely. The whole purpose of the thing, of course, is the investment leads to jobs, which leads to a temporary visa, and then to a permanent visa, and if they want, to the Americans' citizenship. How do developers, how do you guys benefit from this thing? Well, it's got some significant ones. One, the cost of capital tends to be low, and it provides a new source of capital you've never tapped into before. And if you start a regional center, and if it is successful, the returns are significantly high for those invested in the center. And it really is a catalyst for development and investment new projects or recover old projects. There are a lot of places you can get this capital, and they're all country-based. The most prolific country right now is China, followed by Korea and Taiwan. And then there's Western and Central Europe and the United Kingdom. There's a lot of potential other places that are not being exploited, one being Brazil, two others being Indonesia and Turkey. And those you'll notice are all the fast-growing countries. You can also look at troubled countries like Spain, Greece, Venezuela. For us, we're right now active in China, and we are in Brazil and Panama. Keep in the back of your mind, this is a competitive program that's not only American. The most successful one by far to date is Canadian. They just made it much more difficult than it was before, however, in Australia and New Zealand. When the regional center concept was formed, it was because of the failure of the program as it was at the time. One thing that they made it, which made it much more attractive, that the investor did not have to be active in the business, which before he did, and he can live anywhere in the United States, which before he had to live more or less where he ran the company. This dates back when they created it in 1993 to solve the problems. Once the regional center concept was approved, the first step, of course, to get it approved by USCIS, United States Citizenship and Immigration Services, which is not easy. And this approval process takes a considerable period of time and money, and it requires a detailed business plan to include types of businesses that you're going to invest in or property types, and a geographic boundary. For example, for us, we're doing real estate, late-stage venture capital, and mergers and acquisition across 9 counties across Central Florida. In addition, because of the way it's established, since you're in effect a general partner, you'll be pretty much responsible for the cradle-to-grave process. You have identified and qualified the projects. You have to get USCIS approval before or after you make the application. You have to help them prepare we have to prepare the offering documents. In our case, we're doing Reg D and Reg S, so we can, no matter where it's signed, it's legal. You have to market in the target country, which is not easy. Eventually, you'll have to close the deal with the immigrant investor, and the whole purpose of it is get the funds into escrow. Once they're in the escrow, they don't come out unless he's not approved or your project is not approved. Then you have to qualify the source of funds. In other words, they don't want any druggers, or arms dealers. However, you only have to qualify the source of this escrow dollar deposit, so you don't have to do their whole wealth. Then you have to help manage the immigration application approval process, usually done by an immigration attorney in the United States. He probably has an immigration attorney over there. Then, of course, you have to invest the funds, what's the whole purpose of what this program is from your point of view. And then once the jobs are created, you have to account for them and then report them and prove them to use USCIS so he can get his permanent visa. And you have to assist them in applying for that. As far as regional centers go themselves, there are roughly slightly over 100 approved. There's a significant number in the pipeline, maybe as many as 30. No one knows for sure. But of the 100, a lot of them are single project regional centers, not perhaps what you would be concerned with, and only about 10 are active. For the 2 most successful, and no one really knows exactly how much each is raised, but somewhere in the $400 to $800 million each range. Looking how they were successful, it seems to be is you have to have multi-centers, you need a government involvement, and investment, has to be appear to be secure. Why do the investors elect to come to America and get a visa. One is they want an escape hatch just in case everything goes to hell. It keeps coming up that they want the children to be educated in the U.S. Education system, and they want a safe haven for the family. A lot of times the families will stay here, and the entrepreneur will go back and forth. When you ask them in China why you want to go out, they say, I want to get out of the polluted area, and I want to get out of the auto and congestion, which is getting even worse. They're tired of the government looking over their shoulder. They may want to retire in America, and they may want other business opportunities also. In China, you tend to use migration brokers, more or less like real estate brokers, but in this case are like broker-dealers that are attracting the investors. By law there, you have to deal with them. In other countries, it varies. But using China as an example, they would rather have bigger projects than smaller in the $10 to $30 million range because they're going to provide significant marketing materials and effort on their own behalf. So unless you have a stream of or a big project, they're really not interested, particularly the better ones. And you can do a series of done in tranches. So you could do perhaps $20 million a quarter if you have a project that warrants that kind of investment. Smaller is more difficult to sell, at least in China. We're testing the market in Panama now at a smaller number. We'll see. In the China part of it, preferred property types are really glitzy, and they have to have jobs. Hotels, entertainment complexes, restaurants, hospitals, medical facilities like a surgical center, assisted living facilities, and other projects just won't work because you can't generate the jobs, apartments being an example. The most successful project last year was funding for a wind power program in the Dakotas, and it offered zero return, but it was a government guarantee to give your money back. And you have to think it this way, that it's really not an investment. They're parking their money from 3 to 5 years, to get their visa, then they get their money back. We get to use it, in the interim. As far as what the investors are looking for, they say, are you credible? In other words, have you done it before? The first one is the most difficult one ever to do because you never have done a regional center investment before. But if you have done other projects successfully, that hopefully will get you over the hurdle. And then it's your project of interest. Some things they just don't care, at least the Chinese don't care about, but what they don't care about, they may care in Brazil, they may care in Panama, for other reasons. And then they'll say, if all these things come true, will I get my temporary visa? You have to assure them that you'll do all those things necessary to help them make the application to get that visa. And then they say, will I get my permanent visa? What they're really saying, are you going to generate the jobs, and are you going to maintain the reports in such a manner that I can prove to the immigration services that the jobs were in fact created? And will I get my investment back? In fact, barring catastrophe, they'll get it back, and it has to be at risk up to 5 years. You can give it back early, but because of the mechanics of the program, it's unlikely you can give it back before 3. So you can start giving it back once the permanent visa has been issued. They'll ask you, is investment guaranteed? And the answer is no. By law, you can't guarantee it. However, there may be, they don't care if they can get third-party insurance for it, but it's very difficult to find, and so far we have not found any. They'll ask what the return on the money is. It varies in some countries. Some countries it's acceptable as 0, 1 or 2 being more common. In other countries, it's going to be up in the 4 to 5 range, but it will not be as high as a normal investment because they're really concerned about the security of it. And it also will ask, how else will you help me? Will you help my kids get in school? Where should I live? Where do the other where's the other people of my nationality living, and how else can I advise you? From your point of view, thinking whether or not you want to form a regional center, you've got to realize it takes a lot of time, and then even when I apply, will I get it? It's very bureaucratic, and they're not predictable, and it takes a while, up to a year, 6 months minimum. It takes significant, by the way, we've been doing it about a year, we're not proved yet. It takes considerable startup capital, absolute minimum, just to get the approval, it's $150,000 we think it takes another 100,000 committed to marketing to make it believable. So really takes about a $500,000. More is better. You got to have manpower committed. It's almost a full-time job for up to 3 people, and it'll grow over time. And you got to think about the lag time from making the request to getting the approval to the initial funding, which may be 18 months or more. You got to have a plan, because the Immigration Service will make you turn one in. You have to think about what you intend to be. Are you going to provide funds for your own project and be a developer? Or are you going to be an investor and buy properties? Or are you going to be a capital markets provider and provide private equity to other developers? You all got to consider the competition. In other words, is there other regional centers in your area? Are they successful? And you think about the competition. In China, for example, there are a lot of really good projects going in there now. Or think about other areas. You had to figure out where you're going to do it. For our example, we chose basically across Florida on the I-4 corridor. What property types, and they make you define them in a very odd way. And then you have to write, an economic analysis of the impact of one investor in one of these projects, and then figure out what countries you're going to go to. The important elements really are timing, team members who you put on your team, the consultants who you use, which you really want the best team, and you really want local, state, and any other government support you can get to include at least letters saying they support this regional center, but better yet, some other source, which is not common, but when you get it, it's like gold, like the Dakotas. And the other thing, you really got to consider how you're going to market this thing. I think the majority of the ones that fail because they have a unrealistic or zero marketing program. And you got to have projects that are successful and are likely to be of interest to the foreigners. It's a wide range, of how you can structure the investment. In other words, you can inject the money as equity. You can also have preferred equity where you get yours out before the developer does, for example. You can use pure debt, and one advantage of that, you get cash flow early. You can split it, for example, with your investors early. You can make a participating debt and get something off the end. The investors, except for the really 100% guaranteed government programs were zero, because they have been zero so far, really expects a preferred return. It could be as low as 1 or 2 or 3. And the splits above the preferred return tend to be, in some cases, all to the general partner or the regional center, which is, or at least 50-50 split. So you're getting a better than normal split. We think you really should structure the deal to minimize risk as much as possible. Do it all cash, your debt, or you have the ability to take over the project, for example. They want guarantees, but you can't give them. You may later be able to introduce them to an insurance company, perhaps not. As of right now, it's not. But if you can arrange, a pre-approved takeout, which one thing we're working for a REIT to take us out after we do what we're going to do, get as much government backing as you can. Public-private partnerships, which we're also seeking, is a major plus. And any other incentives like government incentives that you can get that will help to convince that the government involved. You ought to have, I assume, you may elect to choose investors to invest with you in the regional center or put up all the cash. But the risk, whoever puts that money up, is a regional center not be approved, and I think it's not guaranteed. You pick the wrong team, they don't like the target you've got. There's all kinds of reasons why you might not get approved. But persistence, you should get approved no matter what. Big mistake, most common mistake, I think, is that they undercapitalize the startup cost. Takes significant money, as I mentioned before. And also not adequate manpower. Some of the other mistakes made by some of the other centers that were approved that did do investments, they had really poor record keeping, could not prove the jobs reform. The foreign investor did get his visa, could not get his visa, therefore he sues the guy, rightly so. Projects not being appropriate, not marketable. Now, You can't develop the marketing network, in country. And culture shock on your part, perhaps, if you haven't worked international before. In my case, I've lived overseas 8 years. I've traveled a fair amount since. I carry the designation Certified International Property Specialist, so I'm a little bit more akin to what was required before. But I mean to tell you, it is hard working in country. Then, of course, you can not create the jobs or not document them properly. They're down the tube again. And for those or other reasons, the visa is not being issued, when the project fails, and that probably end up in litigation. The other risk is, that this program, what's been going for a long time, it has to be, it does sunset, so it has to be renewed. The most recent renewal was 3 years. Hopefully they're working on the effort to make it permanent. If that's the case, that risk go away, but right now it still exists. I don't think that is a likely occurrence. One thing it does seem like, I think it's a real risk, that right now, while the window's open for $500,000 investments, as the population and as the economy increases and the unemployment gets better, and by the way, to get the 500,000 wherever you are has to be 50% more than the national average, which everything in Florida fits. You have to go back to a million. It probably cuts the market by 80% if you do that. Part of your other considerations is that you've got to be prepared to travel frequently. You've got to go face-to-face in country, and I think there's probably at least once a quarter. Our solution was, we took a partner that will be in China. And you got to really develop your in-country resources, figure out who your team is there, and that it might include migration brokers, attorneys, local CPAs, other kind of consultants. It's very difficult to go direct. And then what project's going to work? They're going to be your projects, they're going to be somebody else's projects, and are they well located? So also you got to decide, again, is regional center going to be an investor, a developer, or a capital source, or is it going to be a capital source for all those things, which could also be you? We're trending towards being a capital source. We'll have freestanding partnerships, project by project. We'll inject the capital, either equity or debt or some combination thereof. We've also found, which we'd actually tried earlier unsuccessfully because of our effort with the EB-5 effort, it appears that we'll be able to raise money for straight-up U.S. investments. So we have a new fund called American Real Estate Opportunity Fund, which we've just today, I think, we'll have a letter of intent signed for our first project. And then within a month or so, we'll offer it into China, into Brazil, and into Panama, and perhaps other countries. But then one thing about the advantage of being a capital markets fund, you can get more money out quickly. You got less overhead and less hands-on day-to-day management, and it's significantly, potentially at least, much more profitable. So our original plan was to form a center. It took about a year of thinking about it. It's been almost a year since we decided to execute it and not yet approved. We felt, we'd like to raise $700,000. We set a target for $500, and we have in fact raised $350 so far, and we have another $350 we think we've identified. But the more money you have, the better for the particularly put into marketing. Again, I mentioned our area goes across Central Florida, from Orlando to Daytona and Melbourne. We think that our EB-5 fund can raise $100 million from foreign investors in 5 years, and we think we can raise 4 deals at $5 million annually. In picking who would put up the revenue for the venture startup for the regional center, we chose purposely, did not want any single person to fund it, but we did want people that we knew and trusted. We wanted people that could provide deal flow or expertise and had relationships. The relationships include international relationships, which is really key. If you can get an introduction, it means a whole lot more than going over there on your own. The pro forma for the returns to the regional center investors are incredibly high. And the reason being is the low preferred and the high split ratio above. So I'm talking about really, really significant profit, particularly if you're raising near the amount of money we're thinking. In addition to that, you can fully fee the project. You can provide the asset management fee. You can do your own leasing, your own management, anything else that you would normally pay in a Wall Street type fund. We also intend to use, because of the safety part, we want to have as little debt or no debt until stabilized, and then we'll decide whether or not that we'll leverage and reinvest the money. We may or may not. We just may go free and clear all the way. If you do invest, this provides capital for current projects. If you've got troubled projects, it might be a way of taking the debt out, or it could be for future projects, which would be more or less a traditional development part. One of the examples we're doing now, our current project with our partner in Los Angeles, which is American Dream Fund, we are doing a rehab of a hotel in LA. We're negotiating for EB-5 build-to-suit surgical center in South Florida. A next project to go out here will be an apartment to be developed, and we're going to work with ALF developers here, which is tough in part because it's red line. But if they have U.S. government financing, then we can do it. And begin because we found out how difficult it was. It being in country, we formed a joint venture with the American Dream Fund in L.A. They already have approved regional center in Los Angeles and just got one approved in Las Vegas, and they're in country now marketing the first project, which is a W Hotel. We intend to open a new regional center in San Francisco in Northern California sometime in the future, and we're considering regional centers in other cities. In every case, San Francisco included, we'll do that only if we have a partner in those cities, so that knows the area, knows the projects, and willing to play by the rules that we set up, which is basically being very conservative. We only want a team with experienced companies in foreign cities, hopefully ones that we know. We will take partners in new regional centers, and if the money comes in, we want to deposit two ways. One, it can do it there only, or it can come into our management company for all the funds, and you would own a piece of all the centers, which is our preferred route because everyone's aligned. If we do get to where I think we want to be, which is 5 regional centers, we're hoping to raise money in the $500 million range, which I hope that we'll be able to do. And I mentioned we already have the Real Estate Opportunity Fund going out, which is a $6 million for a flex office building, all cash. What we learned about the process, it takes a lot longer than we thought. It costs more. It's not bureaucratically friendly. As a matter of fact, it's almost like they're trying to make it difficult, impossible for you to do it. The government is. Each country is different. Project marketed package for China may not work in Brazil. The one in Brazil, you think that it would work in China, but perhaps not, because you offer too high a return to China. You say something's wrong with it. You got to really look, at safety and risk. Err on the side of safety, and you got to figure out in whatever country it is which property types they prefer. And again, it varies from country to country. Then how to structure the deal. You got to have in-country presence, either physically there. In our case of the American Dream Fund, our partner is moving to Shanghai. In the case of Brazil, we have an American Brazilian who lived here 15 years that raised money there. He'll be our team member there. We are using in-country Americans and Panamanians. Those are the deals we've cut so far. We also have a deal with the World Trade Center to market for us worldwide. And then you also think ahead, what kind of support can you give the immigrant investors once they get in here? If you really help them get settled, then it's word of mouth. if you treat them right, they'll be your best marketing guy in country because they'll attract other people. I mean, there have been cases where one successful investor eventually attracted as many as 30 others. And you got to be able to operate in a foreign environment. You see the picture of the book there, Kiss, Bow, Shake Hands, that tells you about the cultures in other countries. Our conclusion is it's a hard startup, you know, and we probably didn't do enough research up front. It does provide a feasible alternative as a source of capital. It can be very profitable, and I emphasize very, but most fail, so it's high risk. It can create jobs, which is real purpose. It can provide a feasible route to the visa, again, which is its purpose, but it's very easy to overreach. The ability to market, you know, again, I think is a key to success. Second to that would be the projects that work. You got to minimize the risk. You know, seek joint venture partners and be prepared to change plans if things change, because it probably will. But I think it's worth a shot. You know, as I mentioned, we are taking partners. If you got any questions or want more information on the program or the process, feel free to contact me. Anybody hear me?
Yes, George, thank you. That was a great presentation. It's a very complex program, but I think you know, there's opportunity there, but definitely requires a lot of patience and stick-to-itiveness. So thanks for sharing that really long-range vision with us. For any of you who might want to hear George's presentation again, it's going to be available by close of business today, and it'll be on the NAIOP website. That's the NAIOP corporate website, naiop.org. And on the front page is a large button that says Solutions Series. If you click on that, it'll take you right to it. Our next Solutions Series program will be on November 10th. We don't have another one in October because we'll be at the Development 10 conference in George's hometown of Orlando, Florida. But we will be back on November 10th. We have just gotten word that Glenn Miller is going to be doing a presentation for us talking about his market cycle and just releasing his latest research. So that's always interesting to see his perspective on that. And one more time, I'll remind you that if you have any topics you'd like us to cover, please let us know, and we'll do our best to try and find somebody to speak on those topics. And for now, goodbye to all. Thanks again to you, George, and we look forward to seeing you again in November. Goodbye, everybody.